Hi everyone. So I want to talk about the biggest mistakes that people make when selling strangles on commodities and basically how to avoid them, and also why some of the things are, not as they seem. So sometimes you might think, some sort of like strategy or a way you put on a trade is safer, but it's actually not at all. So I want to break down everything and show you exactly what I mean, and I promise it's all gonna make sense. So let's begin. So the biggest mistakes is first the first one will be selling low delta strangles. Basically, the risk reward is pretty bad. I mean, people think low delta strangles are much safer. Well, they do have a higher win rate, which is pretty much the only pro that I can think about. But they're way less safe, and they have a much bigger vega, which means they're much more susceptible to volatility changes, which is not really good for us as option sellers. And I'm also gonna go ahead and show you exactly what I mean by the risk reward is not as good as selling a bit of a higher delta strangle in just a second. But this is point number one, and it will make a lot more sense in a second. But basically, you have a high win rate, but you have to risk way more than you're making, basically, and it flips the script on you, basically, even though you think you have a pretty high win rate, which again actually depends on a lot of things and not only the delta itself. So second thing is selling low DTEs, so low days to expiration is also, this is a pretty terrible thing, and I'm also going to demonstrate why. So first we'll just go through all of these, and then I'll show you each and every one, because some of them are intertwined, basically. But if you sell low DTEs or expirations with low days to the last trading day, you have gamma risk, which is gamma is the rate of change of delta, and the bigger the gamma, the easier for the position to get into a major trouble, basically. So you definitely want to avoid that, and which is, for me, this is a no-brainer. And there is actually a much lower win rate when you sell lower DTE, and by lower I mean DTEs with like anything under 20 DTE is generally pretty dangerous, and you'll have a much lower win rate and a much bigger risk of waking up and the position is being blown out, and you're losing way more than you thought you would. So this is another thing. Now, the third thing is, I guess, pretty self-explanatory. I guess not setting a stop loss, which is obviously, this is 101. You definitely should have a stop loss. But more than that, not knowing how to check where the stop loss is on the graph is a big one. People just don't know where, they say, hey, my stop loss is 100% of credit. Yeah, cool, but where is it on the graph? Approximately, obviously. You cannot know for 100% certainty, but you can estimate pretty well, and it's going to be pretty accurate from my experience. So people don't know how to do it, and I'll show you exactly how to do it in a second. And also not taking into account the range of the stop loss. So you might know how to do that, the step, but you're not looking at the graph, in a logical perspective, because basically I only sell strangles, so I'm neutral. So I always want to make sure that my stop losses are wide enough to cover the price movement of the underlying, if it decides to go up or down. to a certain extent, of course. So I'm going to go over this point exactly through interactive brokers and the actual graph, so you'll see exactly what I mean. Now, the next thing is not following seasonality patterns, which is, you'll have guaranteed losses. So let's say, you're good at everything else, but you're not following like seasonality patterns, and you, for example, open a strangle on wheat during the harvest season, which is usually between April and July, right? And you open a strangle, you're almost guaranteed to have a pretty bad win rate, and or just lose every single trade. It's very possible, and I've seen it happen. It's just you need to know seasonality, and I have a video actually. Let me show you. The video is actually, so the video is actually right over here. So this is all about seasonality for commodities. So I'll link it below in the description. It's definitely going to tell you exactly, when is the ideal time to trade neutrally, what commodity and why, and the data to back it up, because this is all data driven. So this is a pretty simple thing. You can just kind of look through this video, explains everything, shows everything for each and every sector, for each and every product, and it's going to be pretty self-explanatory. Now, the last thing is not reacting to unexpected events and not staying safe than sorry. So this is probably the biggest thing. So again, if you follow everything else, but you hear that right now as I'm making this video, Trump is announcing tariffs on Mexico, right? And you have a silver position. Now, Mexico is the biggest producer and exporter of silver in the world, or the biggest single producer and exporter. So of course it's going to affect the price of silver, right? Or it might not, I don't know, but most likely it will affect it one way or another. Price might go up or down. The point is, we don't know, but this is an unexpected event, like a geopolitical, I guess, kind of conflict, in a way, I guess. So if that happens, and that happened to me, and I had a silver position, I just took it off. I just, it was up significantly, obviously, but even if it would have been down a little bit or up a little bit, I would have just closed it, because you always want to be safe than sorry in the market, especially if it's an unexpected event, like tariffs, geopolitical tensions, wars, and really anything unexpected that happened. Maybe a mine is collapsing, which is actually really what happened. The biggest copper mine in the world in Chile collapsed, right? So it will, this is unexpected. It definitely has a high chance of affecting the price of copper, which it did. The price of copper went up like crazy because there's less supply now, same kind of demand, right? So things like that happen. You really need to be able to kind of figure it out where it's really not worth taking the risk at this point, because things have changed and something unexpected happened. And this is key thing. This is probably the number one reason why I'm still in the game. It's been almost 9 years or 9 years. I don't know exactly. And I've been doing pretty well for myself. Okay, so let's go and break each and every one of them. So selling null delta triangles, right? So let's start with this point over here of not knowing how to check where the stop loss is on the graph. And is it good enough or is it not good enough? And then we'll compare it to selling a low delta triangle, and you'll see exactly what I mean. And then from there we'll go to the selling low DTE, and again you'll see exactly what I mean when you plot in the stop losses. So let's begin with this. Let's see how we set up the stop loss. So first of all, what will be an ideal range for our stops here? So for me, ideally, if the stop will be somewhere here, and the other one will be somewhere maybe here. So the price have been moving within this range since July 2024. So it's at this point it's like 8-9 months, which is really good. Now let's go ahead and see what kind of position I would open now, and see if it's any close to these stop losses, and maybe we can make it work for ourselves. But basically, we always want to see what's happening in a graph. And if the graph goes sideways, then it's a great trade. But if we have something like this, for example, right, it's been really directional. So there's no way for me to make any kind of reasonable range here, because it's just been really directional. But if you look over here, for example, the price will be moving sideways, and you could have easily say, okay, well, this is the range I want, and then look to see if you can get this. You can actually get this range, but clearly the price have been going sharply here. So this is not it won't be a good example. And I actually don't trade things that look like this. I trade, commodities that kind of move sideways, or in that period of time move sideways. So this is crude oil. So if we are gonna go ahead and look at crude oil, so for me, I just know from experience, about 83 days to expiration will probably do the trick. But usually this is a higher DTE, and I will make I think I'm going to be making a video about what DTE to choose. And again, it's all tied up to what range you get, how the price is moving. If the price is way tighter, then you don't need as much range, and you can go to a bit of a lower DTE, maybe 51 for now. Let's stick to 83. So I'm going to go ahead and sell a delta 21 strangle, 2021, doesn't matter. 21 will give us a bit more, 21.8 here. and yeah, 21 here should be okay. So let's go ahead and look at the profile. Now let's say we are collecting about, what is it, 20 to 40 or 2300, let's call it. Then our stop loss at 50% of credit will be 1150. So let's check and see where is the stop loss approximately. So it's 62.58 on the put side, 62.58. And again, this is approximations, but from my experience, it's so accurate and shockingly accurate. And it's been working really well for me. So 1150, and see here, 74.54, 74.54, right? So this is not a good enough of a range. We definitely want the range to go at least maybe cover this much here, and we have some space on the bottom here. So in this case, and I made a video about it, you can just use a skewed strangle. So by skewed, I mean you can just go, in this case we will push the put side up a little bit, just by 2 strikes. Now we have about 2500 in credit. The stop loss will be 1250. So let's see, where is our new stops here now. So 62.89. So 62 will be 89, give or take, 87, and then 1250 here. Let's see here, 75.25, give or take, 75.25. So this is a bit better. You know what? For the sake of the example, this is a good enough range for us. So we can push the put side a bit more up, and then it will be good enough for us to cover at least this price movement over here, which is exactly what we wanted initially. But let's say for the sake of the example, this is good enough for us. Now this is a delta. I think the average delta will be about 22 on this trade, on this triangle. So one side is delta, 24.9, the other one is delta 21. If you average them out, 21 and 20, it will be delta 23 basically, which is totally fine. Now this is a pretty good range for us, right, to work with. It's plenty. The price have been moving within this range. If we discount this little price movement here, 8-9 months, now we know where our stop loss is. We know that it looks good based on the graph. So this is this point over here, point number 3, and we took into account the range of the stop loss and how it looks like, what it looks like on a graph, and we know how to check it. So we know our stop loss is perfectly fine for us for this position. Now, second thing is, why don't we sell a low delta strangle, right? It must be much better risk reward ratio, right? So here, for example, we're risking about 50% of credit, and the take profit will also be 50%. So it's 1-to-1 risk to reward ratio. And from my experience, I guess my winner is about 93%, a bit over 93%, doing exactly this, what I'm doing right now, what I just did with crude oil. Following a few more rules, obviously, but risking one to make one with a 93% win rate is pretty good. But you got to be very selective with your trades. But let's go ahead and try and sell a low delta strangle and see what a 50% stop loss looks like on the graph. So by low delta, usually low delta is pretty much delta 7, delta 6. Let's go delta 7. This is what people usually even go lower, like delta 5, delta 4, delta 3. But for the sake of this example, let's go to just delta 7. So let's go ahead and look and see what's happening on the graph. So we're getting about $650 in credit, right? So it will be $325 for the stop loss for at 50%. So 325 will put us at 63 and 68. So let's duplicate this, make it a different color. So 63, 68, so right about here. And then the other stop loss will probably be somewhere here, which is 325. It will be 73.12. So 73.12. So it's, yeah. So you can see our range is actually way smaller, especially on the call side, but it's way smaller. But I mean, we can just skew it a little bit and it will look much better. But point is, it's way smaller, right? So, and we only want to risk 50% of credit. So it's this position is actually less safe because the range of the movement is way smaller, and because this is a low delta position, they, after a certain point, they really quickly, these positions go really badly and really against you. So it's really not worth it because it's just pretty terrible. You have a pretty small theta as well, and then if the price moves, or if Vega is massive here, this is also an issue with low deltas, like we discussed. The Vega is pretty big. The only potential pro is you want to have a high win rate, but in this case you'll have to probably risk at least 100% of credit, maybe even 150% of credit to be able to get the same range that we want to get, ideally, because we are looking at the graph. And at that point you're risking $1 to make $3, which is obviously not ideal, right? So this is one reason why lower deltas are definitely not safer. It's I believe lower deltas are for people who are a bit more ignorant. Not everyone, of course, but people who are a bit more ignorant and they don't want to try and understand the market and make better decisions. Because I can guarantee that my win rate, the way I trade, is with Delta 20 will be much better than the win rate, or it will be pretty much identical to the win rate of people who trade those low deltas and have big stop losses. The difference is I'm going to risk 1 to make 1, and they're risking 1 to make 3 potentially, or risking 3 to make 1. Sorry, the other way around. So they will risk $3 to make $1. I got it the other way around, so which is not good at all, right? We risk $1 to make $1, and then with the lower deltas, you will risk $3 to make $1. So not very good. Now let's go and take a look at what it looks like when you sell lower DT, right? So if we go to a lower DT, so lower, I classified lower as anything less than 20 days. Let's go to 22 days. So 22 days, it's the May contract. So let's go to crude oil and let's go to the May contract here. Now it's a bit different than the other one, but it's totally fine. And let's see what kind of range we get. Even if you follow my rules for the Delta 20 and not for the lower delta. So let's see. So our ideal, I guess, range would be something like this, or this is basically approximately what we got beforehand for the Delta 20 and 83 days to expiration. Now let's go Delta 21 here. And here we'll do the same thing, Delta 25.4, because we're doing a bit of a skew. So let's see. So our credit, and let's moving closer. Our credit is about 1200. So 600 will be our stop loss. So on the put side, we're looking at 66.67. So it'll be 66.67. And on the call side, 600 will be 72.57. 72.57. So you can see how narrow this stop loss is, and you can see how within like 3-4 days and not major, like not crazy days, you can easily get your stop loss. Now the only plus sign is you have a pretty big theta. Again, Vega is also pretty big here, and the biggest thing is gamma. So this is the rate of change of delta, and gamma is your biggest enemy basically when you sell neutrally. So definitely want to avoid that. But overall, even if you don't care about gamma and you don't care about theta, and theta is good enough for you, the range is just so small. You can see how that the price been out of this range pretty recently, and it can easily get to one of the sides very quickly, and it will just be a really bad scenario. Now this is how I trade. I'm looking for the best opportunities, of course, this I think in the past 2 years or almost 2 years at this point, I've only had two or three losses, two for sure. I think, let's call it three losses in the past almost 2 years, right? And I've traded quite a bit. Like I've traded at least, I think, 40 or 50 times, at least, if not more. Right, so this is a pretty good win rate, and I keep my losses as small as I can. And obviously, this is just a few reasons, right, why you wouldn't sell low DTE and low deltas. And I'm not just saying it just because this is what it looks like on the graph. I tried selling low deltas. I tried selling low DTEs. I tried a combination of the two. I tried selling low DTEs on high days to expirations. It just doesn't work. It works obviously, but it's far from being the most efficient way to trade. So what I'm showing you is basically what I found to be the best for my style of trading, so which is pretty much only neutral for the most part. And this is everything that I've kind of accumulated over the years, and I found to be kind of the best bang for a buck when selling strangles on commodities. What deltas work, what DTE works, and obviously the DTE kind of depends. If you can go to 50 days to expiration. It depends on how the graph looks. If it's more tight, then you can definitely get away with a smaller range and go with less days to expiration where the theta is bigger. But I would never ever go for anything under like 20 days to expiration or like 20, 21, 22. It's just not enough, not enough of a range. Vega is usually pretty high, and Gamma is also pretty bad. So this is it for this video. Hopefully this was pretty helpful. I feel like it was. I feel like this is the biggest few reasons that I get messages about. Usually when people say sell low deltas, they have a really good 6, 7, 8 months, and then one trade just completely hammers them and they lose everything. Same with low DTE. Low DTE is even way more volatile. So people have pitfalls within 2-3 months usually. And then obviously the whole problem with setting the stop losses and not following seasonality and not reacting to unexpected events, which I have to emphasize is the biggest thing out of everything. People, everyone needs to understand that the market is dynamic. You have to react to what's happening, and you have to understand that sometimes it's just bad conditions. To trade strangles specifically. Right, it's not always favorable for short options or for short strangles. So this is about it. Thank you so much for watching. If you have any questions, let me know, and I will catch you in the next one.